In this week's video, we'll review the latest charts, data sets, studies, and model scores to help us answer the question. Stocks and bonds are caught in the government's debt spiral. Is the economy next? Here are some of the topics that we'll be covering, including the debt doom loop. We've covered this topic in detail in past videos, thus a brief recap only here. CNBC article dated Monday, August 29, 2022. Paper says Fed rate hikes won't bring down inflation as long as government spending stays high. It's based on a white paper that was released at Jackson Hole in August of 2022. Inflation is being driven largely by fiscal spending. Government spending, think Congress. Recent spending has altered the private sector's beliefs about the fiscal framework. The paper concludes the Fed can bring down inflation only when public debt can be successfully stabilized by credible future fiscal plans. The paper suggests that without constraints in fiscal spending, rate hikes will make the cost of debt more expensive and drive inflation expectations higher. How is it possible that rate hikes will make the cost of debt more expensive? When the Fed raises interest rates and the U.S. government has to issue new debt, it has to offer that new debt at a higher rate of interest, which in turn increases the deficit, which in turn puts more pressure on the Treasury to issue even more debt to pay off past debts and future interest. And when you increase the deficit even further, it continues to alter the private sector's beliefs about the fiscal framework, which is a nice way of saying the private sector's beliefs about the government's ability to pay its debts, to get its financial house in order, and the potential impact and uncertainty related to skyrocketing deficits and rising interest rates. It's probably fair to say that if TLT, the long-term Treasury ETF, has dropped approximately 50% from its prior high, that has something to do with the public sector's beliefs about the fiscal framework. And the politically correct way to talk about all that is to talk about the term premium required to hold longer-dated U.S. debt. And in terms of perspective, we should keep in mind, while the debt doom loop sounds extremely scary, and it is a very serious problem, one that we're taking seriously, we should keep in mind that there was also a very serious issue in the 1980 to 1989 window, savings and loan crisis. Having lived through that period, I can tell you, a lot of individuals and investors and pundits got the S&L crisis right, but they significantly underestimated the staying power of the baby boomers, think demographics, the U.S. economy, driven by favorable demographics, and the stock market. So let's assume in the present day you are extremely confident that some significant problems are coming in the debt markets, just as many were in the 1980s. Let's assume you were certain in the 1980s that an S&L crisis was coming and that it was going to be serious. And thus, you decided to stay away from the stock market in the 1980 to 1989 window. Sounds like a good idea. If you do your homework on this, this was a very serious and very long-lasting problem. Logical question. Taking a pass on investing during this crisis, would that have been a good move for you and your family? Well, given the S&P 500 gained 227% in the savings and loan crisis window, you can make your own call on that. Thus, while this is a very legitimate concern, if things turn out much better than expected, as they did in the 1980s, we can handle that if we continue to trade the chart in front of us rather than what we think is going to happen. A lot can change in 8 trading days, which speaks to the power and importance of maximum flexibility. It's the S&P 500 over here, right-hand side of your screen, July 31st, 2023. Several weeks earlier, in a June 16th video, we said it's only a matter of time before we see some 100% normal and to be expected volatility and or givebacks. Because we know Since 1928, there have typically been an average of 1.1 10% or more declines each year. It is standard issue, and it never feels good, and it always feels like a major crisis. A major crisis that's never going to end. Thus, when the market's up here on July 31st, and we know this, we also know that down here around 4,200, there are several forms of potential support. Market cared about the level here, kind of stalled here. There's a gap right at that level here. Acted as resistance in February of this year. Acted as resistance for several weeks in here. And that's the same level of this important breakout and gap higher to risk on that occurred in early June. And we also know that this gap has been left behind. And it wouldn't be shocking if during something like this, the market came back and filled this gap. And logically, when we're up here, we know this is a multiple month base. Took a long time to build, and thus this should represent strong possible support. And we also know on July 31st that we have a very constructive and bullish turn in the 200-day moving average. And we know that if price comes down into this area here over time, the 200-day is going to rise to meet it. Another area of possible support, an upward sloping 200-day moving average. So knowing all of this in late July, if we fast forward to October 3rd, we come right back into the area that's, for the most part, somewhat expected. Right back to the gap, an area of possible support. And what happens? This area of possible support that the market cared about here, 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 and here acts as support. Market comes down right into the area and rallies nicely. Now, this is just 8 trading sessions ago. So on October 17th, it seems like treating this as a 100% normal and to be expected pullback that has a very high probability of remaining above this base. That game plan seems like a pretty good idea 8 trading sessions ago. And yes, we did see the somewhat sloppy head and shoulders pattern up here with a higher right shoulder relative to the left, and a pattern that for the most part, if you shorted right here, you were probably stopped out here when we came back up into the neckline. Relevant, but sloppy, and for the most part, negated right here. So there's no question, we're well aware of the weakness in here. Every correction speaks to shorter term weakness. So things are looking pretty good on October 17th. If we look back just 1 week, really shouldn't be back down here. If this is a confident and successful retest of this base here, we should have moved away, broke this downward sloping trend line, and eventually gone on and printed a higher high. That's not what happened. This is what happened. So this is 5 trading sessions ago. It's hard to see here, but this close here is below this close at 42.29 from October 3rd. Also, an incrementally bad sign. Nothing major, but something that we took note of. In fact, this close a week ago was what prompted this segment in last week's video. These bullet points to be reviewed, as well as these and these. So if you're a stock market bull this week, what do you want to happen? Obviously, you want this area to hold and you want the stock market to move in this direction. So we're still at a point a week ago where some patience is warranted. But it's also prudent to acknowledge, again, you really don't want to be back down here. Hence, the short takes post this week. So this is last Friday. Let's fast forward to Thursday of this week. This is not what you're looking for here. Now we're back into this long-term base. You're really questioning this entire move from point A to point B. And we all know that possible support, markets like to overshoot. So 1 or 2 sessions down here, not the end of the world, but absolutely relevant, because you really shouldn't even have been here if things were operating in a healthy manner. So Thursday, we closed 104 points below the gap here. Basically, this happened down here, which you can find by Googling the title on your screen and our last name. And remember, back on July 31st, we also knew that we had an upward sloping 200-day moving average that would act as a logical reference point if we did indeed come back to test this gap. During Friday's session on October 27th, around 2 p.m. Eastern Time, the S&P 500 was 127 points below the 200-day moving average, and I believe today we printed our fifth close below the 200-day in the last 6 trading sessions. That's starting to drift from the short stay theory of an overshoot. The longer below, the more relevant it becomes. So if we can recapture that 200-day next week, that would be a good sign. May happen, didn't happen this week. Also noteworthy, remember we said just 8 trading sessions ago things looked pretty good on October 17th? Not only did we come back down here, it's the way we came down. Here's October 17th here on a 30-minute chart of the S&P 500. This is an incredibly weak and low conviction tape between point A and point B. The 30-minute chart, we also had a qualified TDST break, which tells you that on this 30-minute chart, DeMark thinks the trend has flipped from up to down, and this is what happened after that. Remember, markets operate in fractals. This is a 30-minute chart. The same concepts apply to a daily chart. This is a daily chart of the triple Qs this week. This is DeMark's Elliott wave count. More than one way to look at it. One way is that wave 5 for the triple Qs upended here, and we're just now starting wave 3 down. And we also, just 2 trading sessions ago, got a similar qualified TDST bearish breakdown. You can see here we came back up and retested that area. So if we come back up into this area here for the triple Qs, we'll learn something based on what happens in this area. Primary trend, 5 waves up. Counter trend moves tend to be 3 waves. So if this is wave 3 of 5, that would imply that the primary trend is down. By no means is that anything other than conjecture, and it speaks to probabilities. Like anything else, it's part of the weight of the evidence. So even if this qualified break is legit, we could come back up into this area here and retest it. You can see we overshot intraday here. The concept of a low conviction tape in here aligns with Dean's tweet here. In terms of keeping an open mind about a wide range of outcomes, this is during Friday's session, and now we're looking at a weekly DeMark chart. Session low on Friday came down right into this TDST level on the weekly chart, which is a longer time frame, and it means this level in this chart is even more relevant than a daily or 30-minute chart. Thus far, this area of potential support held intraday. Doesn't mean it's going to hold next week, but it held on Friday. Also noteworthy, upward sloping 200-week here, approximately 4% below where we were trading during Friday's session. 4% potential downside at this target here. The upside target, 17% above this level, helping us keep an open mind about a wide range of outcomes, including better than expected outcomes in the short to intermediate term. Let's update the chart that we've been covering for several weeks, the anchored volume weighted average price chart, daily chart for the S&P 500 index. Last week we said this was not a good look, and probably fair to say at this point, we didn't hold here, didn't make a stand here, and we didn't hold here either. Relevant and baked into our plan, but noteworthy. Right in this area here. You can see right here, this line, the market cared about it here, cared about it here, cared about it here, and currently it sits here at 4107. We were below that level during the session on Friday, and we ended up closing above it. Not making any assumptions about what happens here. A Fed meeting next week, statement and press conference on Wednesday. So we've already accounted for all of this. This helps us understand a little bit about risk and reward and areas of potential support below. And after this move here, which I think you could make an argument is a 5-wave move down, and if it is, that's not really what you want to see if you're a bull, but that's open to massive debate, we've moved a long way from point A to point B. So regardless of what happens from here, very, very possible the market's either going to make a stand here at possible support, or at a minimum, get a bounce or a counter trend move. Held at a logical level or near a logical level on Friday, held near a logical level on Friday. Not a prediction in any shape, form, or fashion. Even if bad things are going to happen, and that's an if, the market's not going to go straight down every day. Expended a lot of energy from here to here. And if we don't bounce here, just like there was information in this move here, the lack of a bounce here would be troubling. Let's look at the broad S&P 1500, similar lines. This one tied to the high, this one tied to the low. You can see overshoots are not uncommon, just like any area of possible support and resistance. So while this is bad that on Thursday we slashed right through this, we're still near an area of possible support. So you're balancing the negative implication of breaking through it with the positive implication that this area could still act as support and we could still get a bounce next week. This is the chart as of Thursday's close. This is during the session on Friday, so it looks worse now. Similar situation here in the NYSE. This is the COVID low, COVID high. Not unusual to overshoot. The longer below, the more concerning it would become. And notice the S&P 500 is still up in this area here. If it joins the NYSE, it would be down here, and that's around 3,900-ish. Not a prediction in any shape, form, or fashion. These are just additional reference points built into the plan. We'll be moving very rapidly here. Feel free to use the pause button on your video player. See the tweet here? We can find a few charts, quite a few charts, that have similar characteristics to Q1 of 2022. Q1 of 2022. Present day, this is a discernible change in character relative to this move off the October low. Regardless of where we are relative to the fact that it would be logical to get a bounce here, and it is logical to potentially get a bounce here, that's part of the way to the evidence, just as this very concerning look on the chart of NYSE new highs and new lows is relevant. These are all major lows. Compare the look here to the look here. This now looks significantly different than this here just a few weeks ago. Friday's session, not encouraging on that front. Even the Nasdaq's advanced decline line upside down, advancing declining volume upside down. You can pause your video player here. This is the dot-com bust bear market. This is the financial crisis. This looked like it was trying to hold right here earlier in 2023. If we can't erase this look here, it's concerning. Violated the October low and did not, at the first pass, hold this gap, didn't hold this area here, didn't hold the 30, 40, or 50-week moving averages, and broke the upward sloping trend line. This is this week. This is last week. Didn't look too bad 3 weeks ago. You can see this wick here. We tried to recapture some of this and weren't able to do it. Still in close proximity, so a reversal would bring new information. That may happen. It hasn't happened yet. Very, very similar situation here. We've lost some areas that we really shouldn't be losing if this were a clean breakout. Very, very similar situation here. Daily chart as of the close on Thursday. We were down Friday, so it looks even worse. Daily, broader, daily. The reason why we say longer below, the more relevant it becomes. Because a short stay and a pop back up, that can be interpreted as bullish. Similar theme here on the weekly chart as of Thursday's close. We still have the upward sloping 200-week below. Beginning of 2023 here. Discernible shift in the look of weekly momentum. Not an encouraging look here or here. Is it possible this is a falling wedge? Sure, it's possible, but the market has to prove something. There's another discernible shift. It's RSI weekly in 2022 when the market was weak. noticeable improvement in 2023 until recently. That would be the bad news. The good news would be something similar happened here, here, and here. And in all of those cases, we made a stand at or near an upward sloping 200-week moving average. So this is another major reference point. We're not making any assumptions about whether or not the market's going to make a stand there. We'll see how it unfolds. This and this occurred within the context of a secular bull market. Same can be said here and here. Hard to make an argument that thus far this is really any different than those moves, maybe with one exception. Not sure after a move like this we would expect to be back here so soon. So really nothing here thus far that seriously contradicts any of this. That may change. Hasn't changed yet. Some of this has changed. So we've got a great reference point. This is during Friday's session. Upward sloping 200-week approximately 4 to 4.5% below. This is what happened last year. We'll see what happens if we get down there this year. And remember earlier we said a 10% pullback occurs 1.1 times typically in a given year. So you can't make the argument that this move from here to here above an upward sloping 200-week has negated anything in terms of the long-term trend. Can't make that argument yet. And you can't make the argument that a 10% correction above an upward sloping 200-week, that something like that can't occur within the context of a secular trend. Market moved 429% between point A and point B. Table here, the average and median drawdown. These are drawdowns greater than 6%, 16% and 13%. You just can't make the argument that we've done anything yet that's out of character. The key term being yet. We'll see how it unfolds. We'll also have to keep an open mind about the 10% or more pullback morphing into a 15% or more pullback. That typically happens approximately 50% of the time, 46% of the time. Well, we're going to have a recession, and that changes everything. Very possible we're going to have a recession. Recessions aren't necessarily showstoppers for secular bull markets. And we still can't make the argument that the present day really looks significantly different from this, or this. So the first moment of truth, the market has not passed thus far. That may change next week if it recaptures some levels. The more important moment of truth would be this level here, 39.40, which is where the 200-week sits on October 27th. Weekly during Friday's session thus far have not held this area here. Some white space below, a nice reference point down here at 40.50. Don't want to assume that even if bad things happen that we're going to go straight down. It typically does not work that way. This is the VIX on October 11th. This is the VIX as of Thursday's close. Nothing earth-shattering here. We're still at a relatively low level. However, there's no question this is a change in character relative to what we saw between April and early October. Small cap weekly cloud, not a good look, batting 0 for 5. Alphabet daily, aka Google, recaptures the daily cloud in March of this year. It's a discernible shift here. Risk off look in 2022. Attempt to get back into risk on. Current look. On Twitter this week, you can find quite a few charts that have similar characteristics to Q1 of 2022. You can include this chart, BIL divided by SPY. Apple went from a successful retest look in August of this year to what now appears to be a failed breakout look. Longer below, more relevant it becomes. Noteworthy, still well above an upward sloping 200-week moving average in red. Change in character. March of this year, present day, Apple daily cloud, batting 0 for 5. Amazon had a great day on Friday, but it only closed at 127 and change. It has not yet negated this failed breakout look with the anchored volume weighted average price line tied to the previous high. You got to get above 130 and change to do that. Same can be said for this area here. Been a very, very difficult period for trend followers. Why? No trends. A lot of volatility on this chart. No real movement between point A and point B. This is 2020. This is 2023. A false move in this direction. A false move in this direction. And thus far, a false move in this direction. BOTZ had a successful retest look in August of this year. Now it has a failed breakout look, and you can make an argument that this looks similar to late 2021, Q1 2022. If debt is an issue, not particularly shocking that Capital One Weekly is batting 0 for 5 now after trying to recapture the cloud earlier this year. Failed attempt to recapture the cloud, the weekly cloud EEM. So Russell 1000 growth IWF in the ETF world relative to IEI 3 to 7 year Treasury bond ETF. This is the look in Q1 of 2022. This is January. This is the look this week. This was the constructive look in May of this year. This really doesn't look anything like this. Everything we said about the last chart applies to this chart. NASDAQ relative to gold. Let's flip into this area here. Cover this in detail last week. This looks wonderful. Maybe looks easy. We know it's not easy. To move from point A to point B, had to withstand a lot of volatility, 16 and 14. Talked about using the secular volatility model to try to discern between lower risk periods and higher risk periods. And we covered this chart in detail last week, and we said if the present day score started drifting closer to these numbers here, our concerns would increase. Last week, the score didn't really look that bad. Thursday, fair to say, a lot more concerning. And the takeaway here is this may or may not be the best region in here to shift an allocation, but regardless, the weight of the evidence is telling us our allocations based on the evidence in here really shouldn't be the same relative to the weight of the evidence today. It's that simple. And that's all encapsulated in this score, which falls between 0 and 100. The work that we've done, the tipping point, typically 45 to 55. Very, very close as of the close on Thursday. An observable shift deterioration. You can find this on our blog. If we experienced a similar drawdown relative to history, we could fall another 2.2% down to 4,017 hypothetically. We also had a rapid descent in the CCM trend strength model. Our scores long-term, shorter-term, double 90s relatively quickly to both scores dropping below 30. That's rare. You can see the additional drawdowns, a mixed bag. Some of these cases, you really shouldn't be doing a whole lot because the low is very, very close and the drawdown's relatively muted. But the average and median drawdown, after we experience something like this, 11 and 8%, also built into our strategy. That would be the bad news. The good news would be, in 81% of the cases, the market was significantly higher a year later. And it's noteworthy. This is not the gain from the low. This is the gain. So after the signal, you typically fell further. But typically, a year later, you were higher than this level, hypothetically. We covered CTM scores back in June. Weakness tends to be followed by more weakness. And we've incorporated this data into the secular volatility model. Our profile this week, daily, weekly, monthly, similar to this profile here, telling us that we should be open to an additional drawdown. Doesn't predict anything. Remember last week we said it's a vulnerability score. You can't predict how far you're going to fall or how many calendar days you are from the low. But what it tells us is basically what we've been using it for. It tells you when to pay closer attention and start managing risk more closely. That's what it helps us with. It doesn't predict anything. All of it speaks to probabilities. When your scores are higher, doesn't guarantee anything, but the probabilities are much more favorable. And when they're lower, the converse is true. And we also have to respect that it's within the realm of possibility that we could move from this box to this box over time. And that's why it's important to respect this, respect all of this, continue to do this and this. Remember, 400 and some odd questions to produce this score. Here's an example of the concepts. You can see on this chart here, when we get a look like this, a relatively short stay above the upper Bollinger Band and then a reversal, the probabilities aren't nearly as favorable in here relative to in here. This was followed by this was followed by this, and this was followed by this, which doesn't predict anything. But a couple of weeks ago, we were up here. This is the look as of Thursday's close. It's not the end of the month yet. But we do want to be aware that this can lead to something like this, or this. That would be the bad news. It's also extremely noteworthy that it did not derail the secular trend. It did not derail the trend, and it did not derail the trend. It could have helped us with mitigating a drawdown, potentially. Remember, conceptually, secular volatility model and the scores help us discern between higher probability periods and lower probability periods. Here's the look of the chart on October 19th. Let's give you a good visual on why the scores have been falling relatively rapidly. Here's the same chart as of Thursday's close. This is October 26th. This is October 19th. To recap, last week's anything can happen bullet points applied this week, and they will apply next week. If additional adjustments are needed, we will make them. This is extremely important. There is no question that we have a debt problem, but we could have said the same thing a decade ago. So it's very, very difficult to take the problem and nail down the timing. You want an example of that? A year ago, 100% probability from many forecasters that over the next year we would be in a recession. It didn't happen. Timing is difficult. Forecasting is difficult. And history says there is absolutely, positively nothing abnormal about a 10% correction. To the contrary, it is normal and to be expected. Oh, but what about this? What about that? You could have said that during every single 10% correction in the history of mankind. It never feels good, and the market never falls 10% unless there is something to worry about. Is it possible that this will morph into a 15% correction? Sure, it's about a 46% probability. That's what history says. No matter how bad it feels, we're still above an upward sloping 200-week. That is also a fact. This is also a fact. This may be subject to change, and this also subject to change, but they haven't changed yet. Can't emphasize enough, secular never has and never will mean easy. It doesn't feel good. Have the demographics changed? It didn't feel good. During the savings and loan crisis, the demographics, the boomers, they were favorable. Things worked out all right in the long run. Under our approach, it's important for us to have, and we do have, contingencies for more downside in the stock market, for a recession, and for a full-blown debt crisis. Not a prediction in any shape, form, or fashion relative to this, or this. It is prudent to be prepared. You may be 100% accurate relative to problems that are coming down the pike. If you're early or you're late, it may not help you in the financial markets. Day by day, trading the chart in front of us. Debt is a scary topic. It's been a scary topic for decades. It is very possible it is now impacting the financial markets. It's also possible that this too will pass. The world has ended countless times in the stock market, and somehow it seems to eventually right itself. This was extremely helpful over the last 8 trading sessions. Maximum flexibility, no bias, no assumptions, push your ego aside. Preparation and flexibility important during the last 8 trading sessions. They will be very important walking forward as well. When I first got into the business in 1994, this was a hot topic because inflation was fresh in everybody's memory banks. This is going to be a relevant topic for decades, most likely. And every single crisis in the history of the financial markets has opened up countless doors to wonderful opportunity on the other side. It's a general statement, a factual statement. Here's an example. Stock market did incredibly well between 1980 and 1989, and it did even better on the other side of this between the end of 1989 and the year 2000. All of it during a secular, demographically driven bull market that had economic weakness, recession, and significant drawdowns between point A and point B. Thus, since the problems of the day are difficult to fix in the short run, since no one is talking seriously about deficit reduction in Washington, it is more important than ever that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.